Yo, what is going on? We're back with another week of the Financial Mirror, and as always, I'm here to help you achieve the level of financial freedom that you always desired. So, this week we have a very special episode, and I think it's special, but who am I to judge? I'm not biased or anything. Anyways, um, I think that it'll help you out a lot, especially if you've been thinking about investing or putting money into some other vehicle to grow besides the average savings account or whatever. I think this episode is exactly what it's going to need, what you're going to need to help get that started, because it can sort of be intimidating at times, right? But hopefully after this you'll have a good understanding of what exactly it takes, and you'll see it's really not that much to get you started investing, get you started growing, get you started wealth building, whatever stage of your financial journey you're in. Hopefully this will help you get started. So um, I'm gonna jump in. I'm hopefully this first part is helpful. I'm going to give you a quick little of this is going to be some numbers. I'm going to throw some numbers out there. Some of it might be a little foreign. It might sound a little like, what is he talking about? Did he say return percentage? Like, I don't know what a return percentage is, but don't worry, a lot of that'll come to you. So with that, just hang in there. But what I wanted to start with is if maybe you've recently done, and I'm trying to keep this video relevant, so if people are watching this and years from now, I'm sure there's going to be, right now we're on the third stimulus check, right? So I want to keep this relevant. So I'm just going to say I'm going to use the third stimulus check as an example, and we'll see, if there might be a fourth stimulus check. I don't know. Who knows? But I'm going to use this as my entry level example just to get this whole context built and to get this whole thing started. I'm going to use the third stimulus check. If you're watching this currently, or 10 years from now you're watching this, this is or listening to this on a podcast. This is a time where they just passed a COVID Relief Act, and that's given Americans $1,400 as a stimulus check. So I'm going to use that as an example, right, just to build the context, because hopefully that's relatable to a lot of people. Hopefully that's relatable. So on this stimulus check, I've read through a couple different surveys, and these are just the numbers that are coming up with. But 34% of recipients say that they're going to be saving this $1,400 stimulus check. Okay. Not a good idea. All right. So if you're watching this currently, you have time to change. If you're watching this 10 years from now, you're probably going to be like, wow, dude was right, man. It was not a good idea. I shouldn't have done that. But anyways, so current savings rates pay out at about 0.04, 0.06%. It's current as of today in 2021, March 2021. So that's about normal. Inflation rate in 2020 was about 1.2%, and that's projected to be about 2.24% in 2021. So that proves to show that the value of your dollar would decrease by about 2.2% if that inflation rate holds. So what does that mean to you? Like, if all that's foreign, what does that mean to you? That means that if you put your $1,400 stimulus check into a ordinary neighborhood bank savings account that pays out at a 0.04 or 0.06% interest rate, your $1,400 at the end of this year would be worth about $1,370. Okay. Hopefully that rings a bell. Like, holy smokes, just by sitting in this here savings account, it lost value of $30, right? If that inflation rate holds. Maybe that inflation rate is different. Maybe it doesn't. That's just an estimate. Like I said, this video is I want to keep it relevant. I want to keep it relevant to people today as it is next year, as it is 10 years from now. So I'm using these numbers as examples, but the other part of the survey said about 40 to 50% plan on investing some of their stimulus check. Okay. Not a bad idea, right? It's not a bad idea at all. That's what this video is about. But I'm going to give you some guidance on that. And this video is not about what to do with your stimulus check. Okay, I really like that's up to you, right? Like every person's different. Every person's financial where they're at in their financial journey is different. Every person's what they should be doing to achieve their financial goals is different, and it depends on where your journey's at in that. And like I always put this out: if you're ever in need of a financial coach, if you're ever in need of getting some financial assistance, please go to thefinancialmirror.org/contact. There you can fill out a form. That email will come to me, and just put that you're in need of a financial coach, and I will be happy to help you with that. So if you're planning on investing, here's just some numbers. Remember, projected inflation rate of 2.24% this year. Mutual fund return in 2020 was 8 to 10%. So you beat inflation by about 6%. The SPY, which follows SPY, which follows the SP 500, returned about 18% in 2020, and Triple Q's return, which follows the NASDAQ 100 index, returned about 48% in 2020. So you beat inflation by about 46% in that aspect. So obviously these investment strategies offer a much better shield over inflation than that savings account would. So hopefully you're still following along. Hopefully you're still listening. Hopefully you're still eager to see what is this here thing about. What is this thing that you're talking about that can help me grow my money and beat inflation. That's easy. All right, so bear with me. I'm telling you, when this is over, you will have confidence. You won't be near as scared, and you can get started on investing today. Like it's not hard. So like I said, if all those numbers and all that sound like a foreign language, don't worry about that. Just know that investing is a much better shield for inflation than a savings account is going to provide you. So don't get caught up in the fact that you don't know what to do. Like, I don't know how to invest. I don't know, like, these questions pop into everybody's head, but that's what this video is going to help you do. Okay. So two different types of investing, right? And I'm thinking more, these are more long-term investments. So short-term investing, these same approaches can apply to day trading or swing trading or whatever, but that's not what this video is about. This video is about how can you grow your money over time. How can I grow my money? Because if you think about it, your same goal is for your money to sit into a savings account. You're not planning on drawing that money out of that savings account in a year, in 2 years, unless you needed it, right? But if your money is sitting in a savings account, you're probably not touching. There's probably money sitting in a savings account currently that you have that you haven't touched in 10 years, and at a 0.04% return on that money, you've lost a lot of gains that you could have received off that money. So there's two major types, but dollar cost averaging is what this video is specifically about. Okay, there's advantages to both of these, but I'm going to tell you both now. But I'm jumping into dollar cost averaging. That is what this video is all about. So that's the strategy we're going to go over. That's the strategy I'm going to teach you. That's the strategy that you will be using to invest, very little over time. But what dollar cost averaging is spreading your money out. It's spreading that investment out over a time. So using that $1,400 stimulus check, if you split that into fifths, right? 1/5, you would end up investing $280 over the next 5 months. That would be like a dollar cost average, right? I take my $1,400, I take $280 and invest that once a month over the next 5 months. And at that point, I would have invested a $1,400 investment. I got to have a portfolio that I have it invested $280 a month to equal $1,400 after the 5 months. Lump sum investing would be where you take your $1,400 and you invest that all at once. Like today, I put this in, the order won't go in until Monday, but I put that order in and all $1,400 gets put in, boom, I'm in a position, right? $1,400, whether that move goes or that position goes up or down or whatever, all $1,400 is in play right here. Okay. So like I said, both these have advantages, but I'm focusing specifically on dollar cost averaging in this video, on this podcast, specifically dollar cost averaging, because that is a absolute way for you to get started investing, for you to get started growing your money with no matter how much you have to get started. So here we go. We're going to go right into it. So what I'm going to go through, like I said, I've said it multiple times, is called dollar cost averaging. And if you broke all those words down, you know what a dollar is, you know what cost is. So dollar, simply, the amount of currency that you have, the cost, right? So how much does it cost to gain into that position? And you're averaging that cost out over time. So it's great because the idea is all about consistency of investing. It's not about how much you're investing. Okay. So I'm going to break that down one more time. So this strategy is completely about being consistent. It's about making sure that you are consistently investing no matter how much it is. So I don't care if your investment is $100 a month, $50 a month, $5 a month, $7.50 a month. I don't care how much your investment is. Dollar cost averaging is how you can invest, and it's all about the consistency. It has nothing to do with the amount. Now, can you expect your money to grow faster if you're investing more? Why, yes. Your risk goes up, your investment, your return goes up, right? The amount you're risking is the amount it is equatable to the amount that you're returning. So if I can afford to invest $100 a month and you can invest $5 a month, our return is not going to be the same, right? Our return is not going to be the same. However, if that's all you have to invest, that's still all that you had to invest. And my position is, different than what your position would be. So it's very important. It's very crucial to understand that it doesn't matter how much you have. You just take your budget, you figure out your amount of money that you can invest currently, and just go with that and be consistent with it every month, every 2 weeks, whatever it is, however you break it out, so that you can continue to invest over the long haul. Okay. So it's a simple strategy, and if you think about it from a longevity, and I'm going to give you an example. We're going to use COVID as an example here, but it helps you reduce the impact of volatility. So volatility is obviously the how the market's fluctuating, the swings in the market, right? More volatile, the bigger the swings, that market is incurring, right? So if markets are way up and way down and way up and way down, you're going to get in the mindset that it's, that I've got to time it. I've got to get in at the right moment. And that's not the case. Okay. You can't time the market. All right. You cannot time the market. So I'm going to say it again. I'm probably going to say it 15 more times. You cannot time the market. I said tie. You cannot time the market. So don't try. Please don't try. If dollar cost averaging, when you're doing this, it doesn't matter how much time you want to, or how much time you want to put in, try to figure out when the best time to invest your money is. It's not about that. It's about the consistency. So just go for it. So I'm going to use 2020 as an example, and this is going to sort of give you like a real life look at what dollar cost averaging looks like. So I'm going to switch over, and we're going to look at the SPA, right? Which is ETF that follows the S&P 500. So let me flip over. All right. So right here, let's pull this up. So this is the SPA, right? So I just pulled the SPA's chart up, right? And we're going to follow this, all right? So this is right here about the end of February, early March, right? So I've got for anyone that's listening to this on the podcast, we're just looking at the SPA chart, and you can see, and I'm just, this is just a line graph chart. You can follow it, and you can see pretty much about the time that the U.S. really started getting hit by by the impact of COVID on the market, right? So it took a huge hit. It fell from about 338 ish down to its lowest point of about 222.95. Yeah, so just over $100 movement, right? So here's what I want you to think about. I want you to think about you were dollar cost averaging, right? You were dollar cost averaging. So somewhere around here in January, you're like, okay, let me just throw $100 in there. Boom. You're $100. Oh, look, grew a little bit. All right. Yeah. Let's just say you timed this one perfectly, right? You bought in somewhere down in this little dip right here around January 30th, or let's put you right here in February. Look at that. Look at that nice little dip right there. Boom. 324. You got in on the spot at that, and it worked its way up. You started seeing some nice little gains, because think about it. You got $100 in, right over in here somewhere, and then you got another 100 in right here, and all of a sudden you're way up here, and you're like, whoa, I got a nice little win right here, and then boom, this happens. All right, so that happened, right? And you're like, holy smokes, the market's not for me. I just took a huge hit on my $200, whatever. It's not about that. So let me show you how this whole thing works. So all of a sudden you get $100 in right here around, 9-10 January. Then, over here around 5, 6, 7, 8, somewhere around there, you get another 100 in. And then let's move on over here to around March. You're like, oh, this little down peak. And then, it's bouncing back. Let me get this. I'm going to try to time it, right? It's not about timing, but let's just say you got lucky and you just put in like somewhere around here and you put another 100 in. And then we go to April. Let's go on to April. Right over here. Let's put another 100 in. But you can see what we're doing here, right? So if I bought 200 up here, bought another 100 here. Now my average price that I bought is like right here, right? So I bought around around 330-ish. Then my average went down and I bought around 310. So now, I have about a 320 cost average, right? And then I bought again around 250, right? And so now we're looking like a 270 average. So what that's doing is it's making it where this movement doesn't have to move as much for me to break even. So it's because I bought up here. If I would have sold up here at the very top, or if I would have bought up here at the very top and I wouldn't have bought anything else, dollar cost averaging would not be what I did. That would be more of a lump sum strategy where you say, I have $200 to invest. And like that's kind of what you did. If you did $100 up there and you were going into dollar cost averaging, you would want to keep investing, because this is what you're playing. This is what you're banking on, right? This is huge movement down, because now you're bringing your average down. So now anything above that average, right, is profitable. So the idea, and that's where this whole consistency thing comes in. So if you think about it, if you invested the 200 up here and you invested 100 over here and you invested another 100 right here, your average is somewhere like right in this area, right? Like $300, let's just say. It's probably less than that, honestly, but $300 just to be fair. So now if this thing, like right now, you can see the SPY is getting right back up here to where it was pre-COVID. You would just now be breaking even if you didn't do cost dollar averaging, right? So if you did the dollar cost averaging, you would be down here in the 270 and you'd be up about $60 a share. Fair? So that's sort of what this is about. Like, this is about you decreasing your average cost per share. You're decreasing your what you're playing in the market, right? And you're not worried about trying to time this thing. You're not worried about what their earnings report looks like. You're not worried about their finances. You're not worried about anything. You're just worried about throwing your money in there, letting the market do what it's going to do, go up and down, and you're just continuing to invest and getting the best price available at your current time in when you're investing, right? So if you can run through that and you can just continue to play this up and down swing stuff. Look at all this. Like you're like looking at this chart right here. I just backed up and now I'm in like 2018, 2019. All these dips that you were buying, there's your November buy. There's where you would have bought in December, way down here. There's where you would have bought in January, way up here. February, way up here. Like it's all about getting your average, all about just being consistent, consistently investing, and in the long run, it'll pay off. Okay. So the easiest way this is beneficial, right, is that the simple fact that you don't want to spend time if you don't want to spend time studying markets and identifying trends and reading financial statements and playing earnings and all these other things. That's where this dollar cost averaging is beneficial. So all you have to do is set, and you just need to determine a set amount that you can invest every month or every 2 weeks or every week or whatever it is, right? And you're all of a sudden, you're not required to do anything except for continue to invest. You can now just let those investments play the highs and play the lows. And in the end, when you look at this over a longer period of time, you will see that your winnings will go up. Okay. One thing to remember to make this work is you cannot get shaken by the market. So when that COVID drop happens, that can't shake you. That can't mess with your emotions, right? That can't be like, oh, like maybe I should stop investing now. No, like that's when you want to invest, is when that market is dropping. You got to get your averages down. It's markets tend to come back. We're going to go over some things in just a second, but you've got to understand that one piece. Okay, you've got to understand it's all about consistency. Be consistent. Continue to put the money in there. So if you looked at this and you're like, well, what's some reasons that that I benefit from using this strategy, right? Well, first off, the biggest benefit to using this strategy over like a lump sum strategy is that this only requires a small amount to get started. So if you had $5 or $6.75 or $25 or whatever, it doesn't matter. Whatever it is that you have to invest, use it. Doesn't matter the amount. Just get started investing it today. Okay. Minimal research required is a huge benefit to this strategy because, like I said, once I'm going to go through in conclusion, I'm going to walk you through everything that you need to do to get started. It's about 6 steps, 5 steps, something like that. And you will be on your way to investing with this small amount of money or whatever. If you have a large amount of money, I don't care. Just be consistent. That's all I'm asking. Be consistent. So I'm going to walk you through that. But another benefit is this does help take the emotions a little bit out of investing. Now, I'm not saying that there's not any emotions, because if you would have, been invested during that COVID drop, right? You would most definitely have been feeling some emotion when your $200, using that example, is now worth, about $120, $125, right? You lost that money. And at that moment, your emotions are kicking. You're like, man, like I lost that money. I shouldn't have done this, or whatever story you start to tell yourself. But you can't worry about that. But this does help get some of your emotions out of it. But everyone hates to see money be lost. So it's not going to completely eliminate emotions, just help control them a little bit. And it does help that you're not taking a lump sum into a trade that doesn't go your way. So you're spreading it out. It plays, and it allows you to play that position regardless if it goes up or down. So if you did buy right at the top and all of a sudden it's rolling over and boom, it's crashing, by being consistent, you will find out that you'll get to buy back, buy more shares or buy a bigger position once it rolls over and you get back to the bottom, and that's going to bring your cost average down. So that's really what this is about. Like I don't really know how to make it more straightforward, but this is like I said, it's a huge benefit to you because you don't really need a lot of money to get started. You don't need a lot of money to get this thing kicked off. So how do you implement it? It's quite easy, right? So first off, first thing that you need to do is you just need to go to your go to a broker, an investment broker that allows automatic investing. That's the number one thing, because then what you can do is set this up to automatically pull out of your account $15 or $20 or whatever, and you can just set that up to be consistent. Because the biggest thing, I have multiple videos that talk about, you have to pay yourself first. You have to put that money, invest that money first. Otherwise, you're just going to end up spending it somewhere else. So M1 Finance, Fidelity, Charles Schwab, and TD Ameritrade are merging. So either one of those would work. Vanguard is another one, but one of these investment brokers that allow you to do automatic investing is the only thing you really need to do here to get on track. Once you sign up for that account, that is like whoever you use, sign up for that account, follow their instructions on their platform to get into that automatic investing. Now, the fun part is you've got to find what you want to invest in. So let me flip back over. So this, I'm looking at the SPY, right? SPY follows the S&P 500. It's 500 large companies in the U.S., and that's sort of what this follows. You have another one, triple Qs, that I talked about earlier. Oops, I didn't mean to hit F11, but it is what it is. So triple Qs. This follows the NASDAQ 100 index. Once again, everything is up to whatever it is you want to invest in. So if you want to invest in, let's just zoom this out a little bit. If you wanted to invest in triple Qs, go for it. More power to you. ETF, buy in it, stick in it. You just keep playing it. And this is just one thing, right? This is just one thing you're buying into. SPY is another one. And then you can get into like let's try like a Fidelity. There's a 500 index fund. So let's do large cap. There's a large cap growth fund, growth index fund right here. Boom. Let's buy into this guy. Like, it doesn't matter what it is you're buying into. Just find something that you want to FSPGX. Let's look at this one. That's the one we looked at. So FSGPX. I thought that was it. Fidelity, large growth. Let's do one of these. Kind of want to look at that same one. I want to look at the that same one that we saw the chart for. So Fidelity, large FSPGX. Is that what I typed in? FSPGX. There it is. So let's just look, because I just randomly forced. So Morningstar is a great, you can see this is morningstar.com. I'm sure they're going to be around for a while. They've been around for a good long time. But so you've set up your account, you're getting your automatic investing set up. You have to first figure out what it is you want to invest into, right? But look at your platform. So the SPY, the QQ, triple Qs, QQQ, they all are, they both are ETFs, and you can pretty much buy into those, no matter the broker, honestly. When you get into mutual funds, there's certain brokerage accounts that don't allow you to buy mutual funds. Most do, but not all of them out there. So take a look at that. If you're going to go with Fidelity or TD Ameritrade or Vanguard or whomever, make sure you're buying into their funds, because they don't charge a transaction fee or service fee or whatever if you're buying into their funds. That would kill you. That would absolutely hinder your ability to grow your money if they're charging you $49 every transaction, right? So $49 for a lump sum investing, totally different. Maybe it's worth it. I still say it's not worth it. I still don't go for mutual funds that charge a service fee. I stick to whoever that family of funds that my brokerage account's with. But stick to that family of funds. You won't have the transaction fees. So if I had Fidelity, maybe this is one to look at. But what you want to look at when you're looking at these, what you want to look at when you're looking at the mutual funds and the ETFs and all that, is you want something that's got, a couple of years of experience under its belt, right? So if I'm looking at, at this guy right here, this Fidelity large cap growth, let's go to fund analysis. That'll show me the, oh, never mind. What's it under? Is it under performance? I want to see maybe it was under quote, the origination. So, that's the tenure of the inception date right there. So 2016 is when this one started. And that to me, and this is just me, but I like to see funds that have 5-10 years of experience under the belt. And that's just me, though. That doesn't have to be you. Maybe you're like, wow, this thing is, a newly growing piece of artwork right here, and I can get this thing and run with it. Well, yeah, go for it, man. But I'm me personally, I'm more of a, I like to see these 5 and 10 year returns, and that's just me. So, but that's all you have to do. Like, I can come into here and I can run screeners, I can do whatever, but I can do a Vanguard large cap. Large cap is just, big companies, right? Like the Apples and the Amazons and stuff. So large cap index, large cap ETF, Vanguard large cap ETF. Let's look at that. Probably follows like a S&P type thing. But yeah, something like this. Like, you can just go in here and find what it is that you want to invest in and then go with it. All right. So go with it. We're not going to spend any more time on that, but just go in there and play and find out what it is that you want to invest in. All right, so you've come up with your account. You've got it all created. You've figured out what it is you want to invest in. Look at your budget. Figure out how much it is that you can invest. Start investing. Start contributing that much every month. Start contributing that much every week, every 2 weeks, whatever it is. Just build that habit of investing, and then don't stop. You can increase it and decrease it how you need be. Like, if all of a sudden 1 month you can only put in $40 instead of $50, put the 40 in there and keep going. Okay, just don't stop. Don't stop investing. Build that muscle. If you set up that automatic investing, it's going to come out every single month, the same time that you elect. Just don't stop, and you will absolutely be so happy with the results you get. I'm telling you, you'll be happy with the results you get. Whether it's something that you're using it as a savings account, it's like a nest egg type thing, or if you're using it to save for a house, or you're using it to buy a new car, or you're you just want this money to grow. Use this vehicle to build your wealth. Use this vehicle to let that money grow. Okay. So in closing, I really hope that you see just how easy this type of investing strategy can be, and just how easy it is to grow your money when you're using this strategy. So you have your initial research of what you want to invest in, but that's it. After that, you don't have to research this stuff. You can just let that money grow by continuing to invest and utilizing this dollar cost averaging. So you don't have to look at it, every day. You don't have to look at it every week. You could look at it every month. You could look at it. I mean, maybe you do want to look at it every day. I don't know. But whatever it is, but you just keep investing it, and over the long term, year, 2 years, 3 years, you will absolutely thank me. 10 and 15% returns on average for most mutual funds. And then I told you in 2020, the triple Qs returned like 48% or something, right? Not expecting that to happen every year, obviously, but that's good. That's good. So some people out there got a 48% return on their money if they were just investing and investing and investing. So As always, hopefully you're able to take something away from this, and more importantly, to get started on your investment journey, because this is a great way to save. I'm telling you, it doesn't matter what your goal is. This is truly a tool that is underutilized in most people's lives and can really start to rapidly increase the amount of wealth that they have. So don't let that be you. Don't let that be you that's not utilizing this tool, that's not building your wealth through these investments, that's not utilizing an extra $20 a month that you're currently carrying over, and you're like, oh, I got $20 extra, well, let me throw it in my savings account. No, don't do that. Just use this dollar cost averaging, build your wealth, and you'll thank me. I'm telling you. So until next week, hope that you are having a great week. Monday, the market's open. So go in, do this over the weekend, set up the account. Market's open on Monday. Throw that money out there. Get this dollar cost average started, and you'll thank me. So once again, see y'all next week. And as always, continue to grow and continue to be on that journey for financial freedom that you've always wanted. Thank you. See y'all next week.